The Federal Reserve and the European Central Bank have in large part taken differing approaches as they've worked to rescue their respective economies from the financial crisis and then generate recovery after the Great Recession. The Fed started with action in the form of interest rate cuts and several rounds of bond buying to flood money into the system. The ECB, on the other hand, exercised self-restraint in the beginning and felt the pain when sovereign bond markets revolted. However, when ECB leadership changed in 2012, it began a pledge to do whatever it takes to save the euro as a currency. The US economy appears to be on the mend. At the very least, it is much further down the road to recovery than Europe, where a number of countries remain in recession or on the brink of falling back into recession. Economic growth came in far below what was expected in the first quarter of 2014, and fear of debilitating Japan-style deflation is still present. The recent EU parliamentary elections, in which fringe political parties made sizable gains, shed some light on the depth of discontent with prolonged double-digit unemployment and general economic weakness. The Fed's accommodative stance has been a valuable constant for the U.S. during a slow, uneven recovery. It has helped offset the impact of sometimes weak data reports, and in doing so, has provided needed time for the economy to develop real traction. A similar effort, however late in arriving, could be just what the EU needs as well. Looking at U.S. markets, it's hard to remember a time when new highs for the S&P's 500 index were met with as little enthusiasm as what we've seen lately. The S&P 500 closed above 1900 for the first time ever last Friday, and that mark moved even higher when trading resumed after the Memorial Day holiday. The elation that typically accompanies a push into new record territory seems to have been swapped out for skepticism that the current advance is real. But the VIX Volatility Index, or fear gauge, suggests that there's not a lot of worry that the other shoe is going to drop anytime soon. The VIX is at its lowest level since before the financial crisis began in 2007. This contradiction could be an expression of complacency as the bull market moves further into its sixth year. As odd as it may sound, complacency can sustain momentum. While we continue to be cautious about U.S. stock valuations that are significantly above their long-term average, the current momentum is grinding upward and could well continue to carry stocks along with it. That's your investment minute for this week. We'll see you next week.